Hi, welcome to On Investors Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. So on today's podcast, I'm delighted to be joined by Pulkit Sharma, who's our head of alternatives, investment strategy and solutions. And recently, Pulkit has jointly wrote a paper with a key sovereign wealth funds in APAC GIC on the topic of building active multi-alternatives portfolio. So Pulkit, thanks for joining us today.
Thank you, Tai.
So the title of the piece is called Beyond Finger Painting, Building Active Multi-Alternatives Portfolio. And the paper also used the analogy of finger painting to describe a traditional approach to alternatives portfolio construction. Can you explain what that means, and also why a more systematic and more data-driven framework is now necessary?
First of all, Tai, we are deeply grateful to our partner GIC Singapore for their one-year-long collaboration and engagement with us on this industry-relevant thought leadership initiative with JP Morgan Asset Management around alts asset allocation. Now, as one of the largest global allocators, they are a strong advocate for objective research-based conversations on topics that matter to them and to global investors, such as cross-alternatives research and views. And this is the area we are looking for deepening insights on in this joint research. So taking a step back, the paper highlights that traditional asset classes are facing growing challenges in generating alpha and providing diversification. And in public markets, information is widely shared, leaving limited opportunities for sourcing sort of that extra incremental return or alpha. By contrast, both private and public alternatives have evolved from being optional to almost essential in investor portfolios over the past decade. In the past, their scope and accessibility was far more limited, but is not the case anymore with larger investor allocations that are broader and with greater access for both large and small investors. So historically, a lot of the industry research has been done on why alternatives and what are the characteristics of individual building blocks, but not a lot on how alternative building blocks should come together. And so portfolio construction in alternatives has been more art than science, primarily due to the opacity of investment data and also other unique execution challenges. A senior executive of a pension plan 10 years ago described their approach to investing in alternatives as akin to finger painting. While maybe that was fine for them when the menu was limited and allocations were smaller, but not fine today with larger allocations and a much larger menu of options and access available. So alternative allocations actually also give rise to unique market inefficiencies, creating opportunities for allocators to exploit information asymmetries and generate alpha. By appropriately sizing and actively managing their allocations, investors can achieve better outcomes than under a more ad hoc or finger painting approach. So this paper advocates for practical tools backed by sound theory for incorporating more science and less art in the approach of investing in alternatives.
Absolutely. I can definitely see both institutional investors and private wealth investors in the region is taking a much more mature approach when it comes to allocating in alternatives. And therefore, I think your analogy of finger painting moving towards something more systematic, more sophisticated makes perfect sense. Now, in this paper, you also mentioned or discussed two distinct sources of alpha in alternative investing, one of which is dynamic asset allocation, and the other one is manager selection. Can you elaborate a little bit more on how these work in practice and why are they particularly important for multi-alt portfolios?
Absolutely. So first things first is, what do we mean by multi-alts? As a matter of principle, multi-alternatives is the end state for any investor that has more than one category of alternatives in their portfolio, from amongst major categories such as real estate, private equity, infrastructure, private credit, or listed alts. In all such situations, investors are seeking return enhancement and or portfolio resilience. And so alpha generation comes after sizing the betas, which is defined as a prior step in the research work as a strategic asset allocation exercise. And once the SAA or strategic asset allocation is established based on objectives and constraints, then comes the part of harnessing asset class dispersion and manager dispersion both of which are actually quite massive in the alternative space. So we define two distinct sources of alpha, which is the asset allocation alpha, let's call it alpha 1, and manager selection alpha, let's call it alpha 2. We find that manager dispersion is actually high in capital appreciation categories of alternatives and relatively low in income-oriented or core alternative categories. So when capital appreciation causes execution variation, whereas when 60 to 80, 100% of the total return comes from yield, especially high quality yield, then on average, the dispersion is quite low. However, importantly, core or income-oriented alternative segments or return streams tend to be highly uncorrelated to each other. Therefore, an active program should be designed to harness both these sources of dispersion. A simple insight being investors should do more with fewer managers in the core or income-oriented alt space and less with many managers in the capital appreciation alternatives as an efficiency tool. The question then becomes how and by how much does skill lead to capturing these distinct alphas at the LP level? So recall alpha 1 is asset allocation alpha, and that could be captured when more capital is allocated prospectively to outperforming categories than underperforming ones. And this can be quantified by multiplying its several building blocks or components. The first one is the dispersion which exists within alternative spaces or the semi-liquid income-oriented segments, which is structural, as return drivers between alternative asset classes are quite uncorrelated. For example, think of the dispersion between core real estate, core infrastructure, core credit. It can be as high as 20% per year. The next component is the portfolio turnover, which is measured, which is the tools which are useful to shift allocation over initial weights. Now, there is no such thing as you press a button and you rebalance between private and public alternatives. Your turnover is the tool to do that, and turnover can be sourced from many places. New inflows, portfolio income, capital distributions, or rebalancing across public and private alternatives are all efficient sources, whereas the last and arguably the most inefficient source is private-to-private rebalancing. So, we sort of have the programs have to align to efficiency in terms of execution. Then there is the friction cost, which arises from the fact that there are delays and execution gaps between investment decisions and implementation. A common challenge in alternatives is which is structural to the way these asset classes are designed. So stronger product or strategy design that minimizes frictions, maybe by combining perpetual sleeves with long J-curve constant recycling programs or accessing or use of additional levers such as marginal use of public alternatives can be useful to minimize friction costs. And finally, there is the accuracy of relative views, which does matter. So effectively allocating marginal capital depends on the skill in correctly identifying on a relative basis which asset classes are likely to outperform or lag, or which ones are peaking or troughing. And so alternative returns definitely are quite smooth, which means that the great thing is that private alternatives have a momentum to them. And once they peak, it takes time for them to trough and change direction. They don't change direction very quickly. So multiplying that structural dispersion with turnover, then accommodating the friction cost and accommodating the accuracy of views leads to what we call alpha 1, which we believe can be close to 1% base case above the beta, as we demonstrate in a case study in the research work. Then there is the alpha 2, which is quite well talked about, which is the capturing of outperforming managers or manager dispersions and what kind of GPs you select. It is measured as the return differential between selected managers' performance and market performance. So we apply a multiplier which reflects the LP's ability to select managers, and that dispersion between average and top manager could be as high as 10% on an IRR term. We highlight that from an LP perspective, around 10 to 30% of that IRR is capturable. Now, since this ratio is in IRRs, we apply a haircut to make it time weighted. So think of another additional, let's call it 1% plus as a base case addition. So by combining alpha 1 from core alternatives or semi-liquid portion of an investor's allocation and alpha 2 from the opportunistic capital appreciation segments, we can estimate the total base case alpha that is reasonable to achieve in an actively managed, diversified alts portfolio. And this alpha is where ongoing investment skill truly matters.
So I think we often emphasize the importance of active management, both in the public markets, but also in the private market. I think, Pulkit, you've been excellent in sharing with us how does that actually work in practice in the private market. I think the manager selection part is particularly interesting because if you look at the manager performance dispersion in the public market, for example, in equities, it's actually quite small. You could be talking the 1 or 2 percentage points, or maybe no more than 3 to 5. But obviously, in the world of alternatives, whether it's in private equities or private credits, that dispersion can be very significant. And clearly, picking the right manager is important in really not just generating alpha, but determining the overall outcome of your multi-alt portfolio or even the broader portfolio. So next up, we have a 6-step process for building and managing multi-alternatives portfolio. Can you walk us through this framework and share with us how it helps investors to address some of the challenges, such as data fragmentation or some of the market inefficiencies?
Yeah, I think the effectiveness of a diversified alts portfolio hinges on the adoption of a robust, actively managed investment process. In the research we do with GIC, we propose a 6-step investment process to design and build a resilient, diversified alts portfolio. So what does this actually look like in practice? So step 1 is simply starting with the North Star, which is what's your objective? Clearly define your objectives, which are required to you require to solve on a long-term basis. The step 2 involves evaluating the full opportunity set to identify strategies or exposures that can fulfill those objectives in the first place, as well as accommodate any investor or regulatory constraints. Then comes the step 3, which focuses on position sizing. With careful calibration of long-term exposures across various alternative categories, we call this the long-term alts SAA, which itself is not static. So SAA does not stand for static asset allocation, it's strategic asset allocation. And from there is step 4, which brings to life and involves managing sort of the multi-investor portfolios or multi-alts with dynamic capital flows, enabling capital allocation into areas that are relatively bottoming and redemption from areas which have peaked, while continuously assessing for the best relative value. So think of adding some of the alphas beyond the betas in the prior step. Step 5 looks at integrating risk management throughout the process. And then the final step 6 is about evolution. So continuously adopting the portfolio allocations over time. In short, the process is a combination of sizing betas, enhancing alpha or sourcing alpha, access, and also portfolio evolution. Now this process is continuous, repeatable, and adaptable to any client situation. An iPhone analogy perfectly fits the process, where you can think of the hardware as access points or for exposures and software as the insights which feeds the process. So you need both the hardware and the software to constantly update for efficiency of use and delight in outcomes. This is the same and true for all SaaS allocation as well.
I think the 6 steps are clearly equally important, but often a lot of clients, especially in the private wealth or the retail side, they do lose sight of the objective setting, the starting point. I think you, again, excellently pointed out, it's the North Star of how portfolio is constructed. Often we ask clients, what do you want to achieve? And they say, I want to make money. Well, that's surely the journey, but ultimately, if you don't know where you want to be or where you want to go with this particular investment strategy, it's very difficult to design the right return objectives and also how you size or budget your risk accordingly. So I think objective is clearly super important, but if we dive into a couple of these components, you mentioned the sizing of the various components in alternative assets. How do you determine the right size, depending, of course, on the client's objectives?
Yeah, I think sizing is a very important step, and it involves a few dimensions. So the first is what is the inputs you use to size? So establishing the inputs. Then you have to think about using asset allocation frameworks to use those input to size positions, and then which obviously suit the investor objectives. And thirdly is inserting some dynamism into that process. So we spend a majority of our time in calibrating the inputs, including risk and return right. Otherwise, it's a garbage in, garbage out exercise. And the principles we have established for calibrating the inputs for alternatives are that for any asset allocation exercises, firstly, alternative returns should be forward-looking and also long-term for sizing positions. Forward-looking and forward-looking full cycle, so 10 to 15 years. Secondly, they should be calculated in asset class terms and not idiosyncratic terms. That's, we don't want to measure you want to measure the performance of a market portfolio of companies for PE and properties for real estate, and not a concentrated sample of companies or deals. You have to use median manager performance as a reference point, as alpha is the gravy on the top, whereas beta is the main course. You got to use net returns and not gross returns. And very, very importantly, use time-weighted returns, not IRRs or money-weighted returns. So IRRs are not apples to apples with stocks and bonds, and we in our exercises heavily utilize the JP Morgan Asset Management's long-term capital market assumptions for this exercise. We recently released our 2026 assumptions, which follows these principles and also enables calculation of what I call base case long-term premiums alternatives offer. For example, I'll highlight some numbers in dollar terms. For instance, a diversified portfolio of US core property is in this year's forward-looking assumptions close to a 300 basis points premium over investment grade bonds. Core infrastructure is at a 400 basis points premium over inflation. Direct lending is at 150 basis points over high yield, and private equity median manager is at 200 basis points over a basket of cap-weighted public equity exposure. So these are some of the inputs. Now we also spend a lot of time on the risk side, on calculating forward-looking volatility and correlations that should also reflect forward regimes, not backward regimes. For example, a regime where rates are higher, inflation volatility is higher, and not the other way around. We're not in a zero interest rate perspective environment. And finally, on a technical note on the inputs, we adjust the alternatives data for smoothing, as book value accounting is not equal to transaction value or economic vol, and the latter is apples to apples with public market or financial assets. So using these inputs is actually the key for stronger portfolio design. Now, once that exercise is done and the inputs are calculated, then various frameworks can be used to size positions. For instance, investors can calculate portfolio weights using maximizing Sharpe as an objective function, or minimizing risk contribution, or maximizing absolute return threshold based on a preset level of threshold return. Each of these approaches has drawbacks that investors need to be cognizant of and that we highlight in terms of its joint research. They can also use a combination of some of these frameworks. For instance, like mean variance or traditional mean variance frameworks are the most commonly used in the industry. Well, it assumes normal distribution, which is not the case for alternatives. It's highly sensitive to inputs and provides corner solutions when left unconstrained. And a lot of time investors then constrain it, which basically means you're getting to an answer you want in the first place. So we therefore recommend using multiple frameworks and approaching and aligning the framework with the goals as a more prudent method. And finally, allocators definitely then should implement their long-term strategic asset allocation, which is the next 10 to 50-year based weightings, in tandem with the near-term relative value framework, so over the next 1 to 2 years, to improve returns and reduce downside risk. So we think of this as a 2x2 grid, where when long-term and near-term conviction aligns, it's a go for applying marginal dollars, and vice versa. But in the scenarios where the two frameworks, long and near-term, diverge, allocators should exercise judgment in determining the best use of marginal capital, and it should include incorporating other factors such as what's the ranking of the relative conviction, what's the timing of execution, is there a liquidity cost, is there an opportunity cost, which should then align with the decision.
Well, I think that's really interesting in a sense. I come back to my earlier point about the importance of the objectives of what you're trying to achieve, because there's not a single way to think about allocating alternative assets. There are a number of different methodologies. As you mentioned earlier, there are drawbacks to each of them and there are advantages to each of them as well. So if you have a clear idea of what you want to achieve, for example, 3 years, 5 years, or 10 years, whatever time frame that is in your mind, and then Pulkit and his team then can able to use the best methodology to come up with the most optimum way to allocate assets. And also, I think Pulkit touched on a really important point. It's not a fixed exercise. It's an ongoing, perpetual exercise, both looking at the short term 1 to 2 years, and also longer term in order for them to allocate the marginal capital that comes in to the portfolio. So I think there is a sort of multifaceted approach when it comes to building the active multi-alt portfolios. And again, without knowing where you want to go, it's going to be very difficult to achieve it, or it's not going to get the results that you want. So again, for those listeners who are thinking about building this multi-alt portfolio, the key is going to be first establish objectives, and then we can help to build that portfolio with the right methodology, with the right assets, and hopefully with the right outcome. Now, another point you mentioned earlier during the 6-step process is thinking about how relative value works amongst these assets. You mentioned some assets may be going through the peaks, and because the return profile or the profile of these assets can be quite smooth, it will take some time before they turn down, and vice versa. How do you establish this relative value amongst different alts assets?
Yeah, I think relative value is important in areas where there's a lot of non-correlation, and there's a lot of non-correlation, a lot of dispersion across various alt segments. So dynamic capital deployment is critical for to capture these opportunities, which is to figure out highest and best use of that marginal dollar. So alternative asset classes or opportunities that are peaking or troughing at a relative level. So relative troughers orients to inflows, and peakers orient to outflows for building ongoing return enhancement and portfolio resilience. Now, how do we do it? So the relative value framework uses both, which we apply and we sort of put out in the paper, uses both fundamental or bottom-up frameworks and quantitative or top-down frameworks to identify and capture those opportunities. We first start from a top-down. For instance, we use a macroeconomic analysis where we review 100 plus macroeconomic variables forecasts to establish relationships with alternative asset classes. For example, a forecast for BBB bond spreads, which is a typical tenant profile of core unlisted property, has a strong linkage to property returns. Then on a technical side, we look at cyclical performance and leading lagging indicators to see is there a pattern of history repeating itself in the future. And then on the fundamental side, we break down the alternative return building blocks to its medium-term components, and we go sector by sector, bottom up, in understanding the dynamics at play in each sector which builds up to the asset class. So these are non-overlapping insights, which then gives us a conviction on what's the directionality of travel. To illustrate our most recent quarterly relative value forward-looking 1 to 2 year view, which are again at the asset class level and a tool to supplement the SAA process and applied to semi-liquid alts in most cases, that there is, but of course it's dynamic, so the macro and micro variables change. So every quarter we put out different changing convictions, which don't sometimes change a little bit, sometimes change a lot. So in these latest quarterly views, our base case assumption is that tariffs and trade policy uncertainty are expected to generate higher inflation and uncertainty around it, especially, and weighing on demand, so creating a more subtrend economic growth level. So we hold a positive view on private market diversifiers with predictable returns versus public equity linked assets. So unlisted infrastructure and property assets show up as relatively higher conviction. So infrastructure has also tailwinds from electrification, moving infrastructure transport, benefits from tariff disruptions, creation of resilient supply chains, and linkage to inflation. And real estate, which has a cyclical bottom, is now underpinned with solid fundamentals and aided by the resetting of its capitalization rates. So these areas look higher conviction. Private equity secondaries with discounts narrowing is a neutral, along with the broad-based direct lending where we support quality as spreads are tightening, liquidity is plentiful, and stress can come from supplying of loans to weaker credits. Relatively lower conviction is to senior loans where the competition is very stiff and it's more becoming like a rate product, rate strategy, rate exposure. And while returns will still be positive the spreads are tight. And then there are certain other hard assets where CapEx and OpEx dominates and there is more and more equity linkage. Those tend to be on the lower conviction side. So this relative value view is highly valued by many clients. So many large investors and our partners note that by the time they spot opportunities and research on them over several quarters, the market relative opportunity has already moved. So our independent quarterly updated views therefore helps provide an additional tool to capture marginal capital allocations, or at least the directionality of it, which can be then used in tandem with longer term sizing.
I think what Pulkit, you do and your team does is very unique in the sense that there are clearly some other asset managers who are focusing on one particular alternative asset class, for example, private equities or private credits or infrastructure. But at JP Morgan Asset Management, we have a broad suite of alternative assets, and therefore you have the expertise and also the flexibility to choose from a broad range of assets rather than being nailed to one particular type. I think that is quite a unique value proposition.
As they say, when all you have is a hammer, all you see is nails.
Exactly. So look, we've covered a lot of ground today, and this paper, for those of you interested, it is available on our website, and we include a link in the show notes. But maybe to summarize how investors should think about building an active multi-alts portfolio, do you mind just again summarizing one or two things that you feel is the most important for our listeners?
Well, our partners at GIC state, and we agree, that no decision on using data and insights for better sizing and actively managing the alts portfolio, whether it be for at the asset class or sleeve level or the overall alternatives level. So no decision is also an active decision, where we demonstrate that investors may be leaving both long-term portfolio resilience and alpha generation on the table. So harnessing these outcomes, which are actually more readily available in the alt space with its inefficiencies versus public markets, is sort of the key ingredient to stronger portfolio design. So we believe that the harmony between portfolio design and practical portfolio management that harnesses forward views, minimizes friction, and is flexible is how stronger outcomes can be generated. And if you zoom out and you think about large asset owners who have existing portfolios, approaching strong themes or convictions from the bottom up, and then integrating it with long-term goals and convictions can be a very useful tool for return enhancement and portfolio evolution. Whereas for instance, the private wealth space or smaller asset owners who are beginning their journey, the focus should be on alignment with long-term goals and appropriately sizing allocations to provide a diversified exposure, as well as using structures that are flexible, diversified, and can evolve to capture this alpha we talk about. They get to build the diversified portfolio from the get-go. So using a balanced and prudent mindset, data and insights sort of oriented portfolio allocations is the way to go. They should also ensure that forward-looking returns are not overstated, risks around principal loss and illiquidity are well understood for ensuring long-term success.
So I think, again, coming back to the title of this piece, Beyond Finger Painting, I think hopefully Pulkit has given us a lot of specific, systematic, and really workable framework on how to think about active multi-alts portfolios rather than being smudgy and being fluffy. There's plenty to work with. Again, so thank you so much for your time, and thanks for joining us, and hope to get you back in APAC very soon.
Pleasure to be here. Thanks, Tai.
Thanks for listening. If you enjoyed this podcast, please share this with your friends and colleagues, and of course, consider subscribing. We do have a broad range of insights into alternative assets. On top of the paper that we discussed today, we also have the Guide to Alternatives, which is also available on our website as well as our Market Insights app. If you have any questions on this topic or other topics you would like us to discuss in the future episodes, please reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you next time to discuss what's on investors' minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.